Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. What a week it was for the rupee. Volatility is at its best. In the same week, it has shown in 91.07, and by the closing time, it closed at 89.27. In today's presentation, let us understand why rupee got stronger and what next. As discussed in our last to last week video, that whenever RBI does sell by swap, it indicates that rupee might get stronger. Similar move happened in 2025 Jan when rupee got stronger. This time also it followed the same strategy. Apart from that, on Friday in last 5 minutes when market was not expecting any kind of intervention from RBI, RBI intervened and ensured that rupee breaks 90 kind of a level and closed near 89.27 kind of levels. And now the question is what next? In order to understand, let us understand what are the factors which are going to affect rupee positively and what are the factors which are going to affect rupee on a negative side. Let me start with the positive part. The first positive point is India's inclusion in Bloomberg Bond Index. It is expected that India's FAR government bond is likely to insert it in Bloomberg flagship global aggregated index, which is close to 3 trillion asset value. The first official announcement is expected to be announced in the month of January 2026. If that happens, we are going to get close to $25 billion worth flow in Indian bond market over the next 10 months period. India is likely to get more inflows as compared to other Asian countries like China, where the yields are lower as compared to India. So that gives an additional advantage for India to attract FPI investment in bond market. Second positive point is because of higher tariff in US, India's export is getting slower. In order to counter attack this point, what the government have done, it is on a continuous process with other countries to sign free trade agreement. Last week, India has signed a free trade agreement with Oman, giving us a 17 deal in last few months. And the third positive point is India's trade deficit has come down to a 5-month low, currently at 24.53 as compared to 41.68 billion in the month of October. Now let us see what are the negative points which can impact rupee. The first negative point is RBI is still short close to $59 billion as per its November monthly released data. The data is as on 30th September. Approximately 55 to 60 billion dollars RBI short hai, which is close to its 8 to 10% of their FX reserves in the currency side. That's a huge short position. It can trigger that RBI can come and buy at lower levels. Now let us, and the third negative point is FIIs have been selling in Indian equity and debt market. In the calendar year 2025, they have sold close to $10.1 million. In the month of December itself, they have sold close to $2.1 billion on a net to net basis, as compared to calendar year of 2024, where they have invested close to 19.9 billion. If FIIs continue to sell in Indian equity and debt market, rupee might be under pressure. Last week action suggests that RBI might not allow rupee to get weaker on immediate basis. In fact, from the coming week onwards, FII activity will be muted and global markets might be calmer as most of the hedge fund will be going for a year-end vacation. This would support the RBI to come and sell when the market liquidity is low and allow further appreciation. As of now, only time will tell which direction the currency is likely to move, but there are higher probability that if 89.20 is broken, most likely, then the pair is likely to move towards 88.50 to 88.30 kind of levels. Near term support in rupee is near 88.50 to 88.60 kind of level, and resistance is near 90.40 to 90.50 kind of levels. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporter. Last week momentum from 91.07 to 89.27 indicates that any thin margin exporter should believe that they should hedge on a continuous basis. For next week, we will suggest them they should keep a strict stop loss of 89 kind of a level. If 89 is broken, then they should hedge 80 to 100% of their open exposure via forwards or option. Now let us discuss strategy for thick margin exporters like textile exporter or engineering exporters. From last couple of weeks, we have been suggesting them that they should increase their hedge ratio at higher levels. Now they should not panic, and in case if rupee appreciates towards 88.50 kind of level, they should ensure that they can use their or they can utilize their existing forward which are booked at higher levels. Now let us discuss strategy for importers. If anyone is following our YouTube video, they will appreciate the fact that from last couple of weeks we have been suggesting importers that they should only focus on covering near-term imports and not longer-term imports. And to that we have suggested that they should cover via option. So if rupee gets stronger, they get a downside participation. Now we are suggesting importers at between 88.80 to 89.10 kind of a level, they can completely cover their next 30 days import via forward. With this, I will end my today's presentation. Jai Hind. Namaskar. फिर मिलेंगे next week. Thank you.